All right, let's talk Nike. Their recent earnings report, well, it was a fascinating one. On its face, the headline number was a beat, but the market's reaction? Absolutely brutal. A double-digit sell-off. This wasn't just a knee-jerk reaction. This was the market fundamentally resetting its valuation of the company. So let's deconstruct what the big money saw that caused such a violent move.
And this is the disconnect right here. You see an earnings per share of 53 cents, which blew past the estimate of 37 cents. Normally, that's a recipe for a pop in the stock. Instead, it gets hammered, down 11%. That's the market sending a crystal clear signal. We are no longer interested in these engineered bottom-line beats. We're looking for real quality growth, and it was nowhere to be found.
So that begs the question, right? What were the red flags buried in this report that the headline number just completely glossed over? We're going to peel back the layers here because this isn't about one bad quarter. This is about deep structural issues that are now being priced into Nike stock for the long term.
Let's start with that headline itself. The market saw right through it, immediately flagging this as what we call a low-quality beat. And it's a super important concept, because not all earnings beats are created equal. This one, well, it was hiding some pretty significant problems under the surface.
Okay, so let's walk through the numbers. Look past that EPS number for a second. Revenue? Basically flat. That's your first warning sign. Then you get to gross margin. It fell off a cliff. And Nike Direct, their own website, their own stores, which is supposed to be their most profitable channel, it actually shrank 8%. So that earnings beat was almost entirely manufactured by slashing costs, not by actually selling more stuff at a good profit. That is just not the sign of a healthy, growing business.
And let's just put a fine point on this. A 300 basis point drop in gross margins. For a company like Nike, that is a massive, massive hit to profitability. The market looked at that one number and understood with perfect clarity that the core engine of the business, selling shoes for a premium, is seriously sputtering.
So where is all that pressure coming from? Well, that brings us to maybe the most alarming signal in the whole report, the structural breakdown in Greater China. We have to be clear here. This isn't just a bad quarter. The data is screaming that there's a fundamental decoupling of the Nike brand from its most critical growth market.
This chart tells you everything you need to know. The broader Chinese retail market, while not great, was still growing. But Nike's revenue in the region, it collapsed by 17%. That huge gap between those two bars proves this isn't a China macro problem. This is a Nike-specific problem. They are actively losing market share, and they are losing it fast.
And if you want the single most damning data point of the whole report, here it is. Digital sales in China were down a catastrophic 36%. This isn't just a blip. It signals a collapse in brand relevance with younger digital native shoppers. They're turning to homegrown brands like Li-Ning and Anta. For a brand like Nike that's built on youth culture, losing that generation is, well, it's an existential threat. And look, you don't have to take our word for it. Management is basically telling you what's going on. When the CFO uses language like consistent challenges with old inventory and weak traffic, that's just corporate speak for this is not a one-time issue. We have a deep structural problem in what was supposed to be our biggest growth engine.
Now, this disaster in China feeds directly into the bigger picture, a structural shock to Nike's long-term profitability. And it's not just China. There are two really powerful forces, a true double whammy, that are squeezing Nike's margins, and it looks like it's going to last for the foreseeable future.
Let's break this down, because it's so important. First, after years of trying to sell directly to you, the consumer, they're now running back to their wholesale partners like Foot Locker. Sure, that helps clear out inventory, but it comes at a huge cost to their profit margins. Second, they're getting smacked with a massive new tariff bill on products they import from Southeast Asia. And the scale of that tariff hit is just staggering. Management actually put a number on it, a $1.5 billion hit to their annual costs. This is a direct structural blow to their profitability that in this environment, they just can't pass on to consumers. It's coming straight out of their pocket.
So you've got financial pressure, you've got regional pressure, and on top of all of that, you have a product problem. All this financial stress is being made worse by what a lot of us see as a really stale product pipeline. The market is tired of hearing promises. Nike is now officially what we call a show-me story. The burden of proof is all on them now. This timeline really just lays out the danger zone for them. They're stuck navigating this tough market with aging franchises. The new products that are supposed to reignite the brand, the Vomero 18, the Alpha Fly 4, they don't even hit shelves until well into next year. That creates a really dangerous air pocket where the brand can feel old and lose even more ground to competitors.
So the key thing to understand is this. Investors are no longer buying the story of future innovation. They're skeptical. They are waiting for cold, hard data, proof of what we call sell-through, actual sales to consumers at the register, before they will even think about buying into a turnaround story. The benefit of the doubt? It's gone.
And all of this brings us to the main event. With the stock beaten down to multi-year lows, the debate is now really clear. Is this a rare opportunity to buy an iconic brand on sale, or is it a classic value trap?
This sums up the two competing arguments perfectly. The bull case is that, hey, the worst is over. Inventory is clean, they're getting back on shelves at wholesale, and their cost discipline is pretty impressive. But the bear case, well, it's powerful. You've got real market share bleeding in China, the brand's heat is clearly fading, and you have margin pressures that are not going away anytime soon. And when you strip it all away, that's the fundamental question the market is grappling with right now. The stock looks cheap on paper, but the quality of the business seems to be degrading. So is Nike a legendary brand on the cusp of a comeback, making it a true value stock? Or is it a value trap, a mature company whose best growth days are now firmly in the rearview mirror?